Hello and welcome. Consider for a moment the price tag on the shirt you are wearing or the coffee sitting on your desk. To a consumer, that number is a cost. To a casual observer, it is merely a label. But to the strategist, price is something far more profound. It is the razor's edge of business. It is the only variable in the entire marketing mix that actually generates revenue. Everything else, product design, advertising, distribution, is just a cost. Yet despite this critical importance, how do companies actually decide on that number? Is it a mathematical formula derived in an economics classroom? Is it simply a matter of adding up costs and tacking on a profit margin? Or is it a psychological signal, a weapon in a competitive war? We are embarking on a deep exploration of strategy in the market, specifically focusing on strategic pricing decisions, which is based on Chapter 3 of the book Strategy, Sustainability and Management Accounting. Over the course of 3 episodes, we are going to dismantle the mechanics of pricing. We have structured this journey around 3 distinct themes. First, in this episode, we will examine the old guard, the conventional models of pricing found in neoclassical economics and traditional management accounting. We need to understand the rules before we can see why and how they become obsolete when approaching pricing strategically. Second, in part 2, we will shift gears to the contemporary strategic view. We will explore strategic pricing, looking at how market segmentation, targeting and positioning, the STP approach, transform pricing from a math problem into a branding powerhouse. And finally, in part 3, we will get into the engine room. We will look at the specific cost management techniques that underpin these strategies, specifically target costing and lifecycle costing. But here in this episode, our focus is on the foundations. We are looking at the traditionalists, the economist, and the conventional management accountant. Before we dive into their models, let's briefly orient ourselves. If you recall our discussions from the previous chapters, we spent considerable time tracing the evolution of strategy. We looked at historical discourse to define what strategy actually means. We analysed the heavy hitters, such as Michael Porter, to discuss how firms structure themselves to gain a competitive advantage. We established that a firm operates in 3 domains: the hierarchy, the point of production, and the market. From a positioning perspective, the market is arguably the most significant of these. It is the arena where the battle is won or lost, and pricing is the primary weapon in that arena. So let's begin with the first dominant perspective, the neoclassical economic model. If you have ever taken an introductory economics course, this will feel familiar. This model is elegant, logical, and mathematically precise. It is built on a very specific assumption that the primary objective of any firm is to maximize profit. In this world, the firm is a rational actor. The decision-making criterion is the profit maximization rule. Mathematically, this occurs at a very specific point, where marginal revenue equals marginal cost. In plain English, you keep producing and selling units until the revenue you get from selling one more widget exactly equals the cost of producing that widget. If you produce one more, you lose money. If you produce one less, you leave money on the table. In this model, the market is represented by the demand curve. It assumes a causal link. As price goes up, quantity sold goes down. The firm looks at this curve, looks at its cost structures, and mathematically derives the optimal price by equating the marginal cost to marginal revenue to squeeze every drop of profit from the system. The price at which marginal revenue is equal to marginal cost, as shown in this diagram, is considered the best because that is the price at which the profit is maximized. It sounds perfect, but here is the problem. It doesn't really work that way in the real world. Despite its theoretical elegance, the neoclassical model suffers from what we might call strategic blindness. First, consider the goal itself. Do managers actually wake up in the morning obsessed with absolute profit maximization? Rarely. In practice, managers are driven by budgets, by satisfactory return on investment, or by specific incentive plans. Sometimes a firm will intentionally lose money. Think of a tech startup pricing low to gain market share, or a loss leader product in a grocery store. The neoclassical model struggles to account for these strategic nuances. Secondly, this model has a very limited view of the market. It reduces the complex chaos of human behavior, competition, and culture into a single line on a graph, the demand curve. It doesn't account for a competitor launching a new product next week, or a shift in consumer political values, or supply chain disruptions. And perhaps most critically, it strips the firm of its strategic agency. In the neoclassical view, the market structure dictates the terms. The firm is just a passive calculator, reacting to the demand curve. But as we learned from Michael Porter in our previous discussions, strategy is about agency. It's about firms shaping the market, not just reacting to it. Now, let's pivot to the second traditional perspective, the conventional accounting model. If the economist is looking at a graph using calculus of optimization, the accountant is looking at the ledger. This approach is commonly known as cost-plus pricing. The logic here is incredibly seductive because it is simple and safe. You calculate how much it costs to make your product, materials, labor, overheads, and then you add a markup to ensure a profit. If it costs you $10 to make and you want a 50% margin, you charge $15. Done. The complexity here usually lies in the details of the costing. Direct costs like labor and materials are easy to trace. The nightmare is overheads, electricity, rent, administrative salaries, and many other expenses incurred over the heads of the factory floor workers and managers. Traditional absorption costing tries to spread these costs like peanut butter across all products, which can be inaccurate. More modern methods like activity-based costing try to be more precise by tracing costs to the specific activities that drive them. But regardless of whether you use traditional absorption or sophisticated activity-based costing, the fundamental flaw of the cost-plus model remains the same. It is entirely internal. We call this a push strategy. The price originates on the factory floor and is pushed onto the customer. It says, "This is what I spent, so this is what you must pay." But the customer doesn't care about your rent or your electricity bill or your inefficient manufacturing process. The customer only cares about the value the product brings to them. This brings us to a critical weakness of the accounting model. It passes inefficiency onto the consumer. If a company is wasteful and has high costs, the cost-plus model simply increases the price to cover it. In fact, if your profit is a percentage of your cost, you theoretically make more absolute profit the more inefficient you are. In a competitive market, this is a death spiral. If a competitor can manage costs better, they will undercut you, and your required profit margin will remain a fantasy on a spreadsheet. So where does this leave us? We have the neoclassical economic model, which assumes a rational world that doesn't exist. And we have the accounting cost-plus model, which ignores the customer entirely in favor of internal arithmetic. Both of these models view pricing in isolation. They treat it as a standalone decision, separate from the product design, separate from the advertising, separate from the brand. But as we look ahead to the next leg of our journey, we know that in the modern landscape, shaped by globalization, digitalization, and intense rivalry, this isolation is dangerous. Strategy requires integration. This sets the stage perfectly for part 2. We are going to move away from these push strategies and explore pull strategies. We will examine the STP framework: segmentation, targeting, and positioning. We will see how modern firms don't just calculate a price, they position a price to define who they are and who their customers are. We will move from the factory floor to the mind of the consumer. But for now, reflect on this. If your pricing strategy is based solely on your own costs, are you selling value or are you just asking the customer to subsidize your existence? Join me in the next episode where we step out of the ledger and into the market.